Welcome to Sectors Made Simple, or welcome back to Sectors Made Simple. My name is Jonathan Stav, and my goal here is to show you why investing can be made simpler with just understanding a few basics of how the market works. And today, I want to talk about one of those basic ideas with you: sector rotation. Sector rotation seems like a very scary idea at first because it uses two words that we might not be familiar with: sectors and how they rotate. But by the end of this webinar, you will have a strong understanding of what sector rotation is and why it should be a part of your investment strategies. So without any further ado, let's get into it. Before we get into the fun stuff, we need to go through the not so fun stuff. This is an educational webinar. My goal here is not to tell you to go buy something or to follow every single word I say. The goal is to show you a way of thinking about investing and concepts that might be new to you. So, it is meant to be educational. And because of that, please remember, nothing I say is suggested or is given as financial advice. My goal is to empower you to make your own investment decisions, not to trust some talking head on the internet with all of your money. Sound good? Cool. Let's get to it. So today we're going to talk about sector rotation. We're going to go into what sector rotation is, how it works, why you should care, that's probably the most important part, how we use sector rotation here at Sectors Made Simple, and lastly, some ways that we can use sector rotation to invest. Now, a common question when it comes to investing is, what the hell do I invest in? I know it seems silly, but this is a question that you will always be asking. What do I invest in? Some people, they're going to choose to just buy one thing and hold it for years or months. Other people, they constantly have a little bit of money set aside so that they can buy that new thing that they saw on Wall Street Bets or somewhere online. The reality of it is, that question is hard to answer because we want to find strong companies to invest in. I would hope that every investor's goal is to buy investments with the hope that they go up in value over time. Basic idea of investing, right? Make some money. But this is a very simple idea that can be very, very difficult to answer. That's the reason why if you ask anybody, what should I invest in? You'll probably get a wide range of different answers. Some people are going to give you the meme answers of GameStop or AMC. Other people, they're going to give you the very standard Nvidia or Tesla. Other people might give you other ideas such as XLK Technology or XLC Communications. So we got to remember that the stock market is not just Apple, Facebook, Facebook, and let's throw Nvidia in there. It's not just a few big companies. It's actually thousands of companies, big and small. So how do we find the best ones? Because the reality of it is, it's really nice to invest in Microsoft or Tesla because they're names we're familiar with. But when it comes down to it, 5% return in Tesla is the same as 5% return in NextEra Energy. So the most important thing that should matter to us is, does that company have potential for profits? And that is what our real goal is. Find those diamonds in the rough and those areas of opportunity. Which leads us into market sectors. Market sectors tries to help us answer the question, what do I invest in? By bringing our list down from 5,000 companies or 5,000 or more to a much more manageable number. So market sectors are a way of grouping companies based on what they do. So there are many different ways that we can do this, but an organization called MSCI has set up one of the most widely used sets. This is going to break the entire stock market down into 11 different sectors, where Every single company belongs to one and only one of these sectors. For example, Nvidia, Apple, and Intel all belong to the technology sector. Meanwhile, financials is made up of major credit agencies or credit providers and banks such as Bank of America, Chase, Visa, MasterCard, and more. Meanwhile, energy is going to be things like ExxonMobil and Chevron, and the list goes on and on. So now, what we've done is we've taken the entire stock market and boiled it down to just 11 groups. 11 groups is a little bit more manageable than 5,000. But before we get too far into this and start talking about how do we compare these 11 to find the leading sector, we got to first ask, why do sectors matter? Is this actually a fair way to compare companies? If our goal is to find the top company and we're moving away from companies, we want to still make sure that what we're looking at makes sense. So let's ask the question, are sectors a good substitute for looking at individual companies? I'm not here to sell you some fairy tale. I'm here to tell you they don't always live happily ever after. And that sectors being a good substitute for every company in the market is not always true. The largest companies in the market, think Facebook, Tesla, Amazon, Google, Nvidia, all of them, they tend to have a little bit of a mind of their own. The reality is they are massive. These FANG companies that you'll see over in the news, or these large groups of companies that are hundreds of billions, if not trillions of dollars, they march to the beat of their own drum. They very rarely will fall in line with what every other company is doing, especially every other company within their sector. So these companies we're going to kind of put aside a little bit. And I'll talk a little bit more about why later. But for right now, we're going to ignore the really, really big companies in the stock market because these companies are typically in the news quite a bit. You'll see plenty of news about what's going on with Tesla, what's going on with Nvidia, what's going on with Google. And these different news cycles will make or break their stock price. It is no surprise to wake up and see Tesla skyrocketed 8% in a single day or fell 15% first thing in the morning. These are very normal things for us to find out. And while some people can tolerate a 8% swing first thing in the morning, I can't. So if we look beyond just these large companies that are high risk and high reward opportunities, one of the largest drivers of price change is not how well the company is performing, it's how well its sector is performing. A number of different studies have been done looking at how much does the performance of a sector impact the performance of a stock's price. And while there's no one number to rule them all, every single study has shown somewhere between 50 to 80% of a stock's price change is due to its sector and not the company itself. Think about that. The majority of a stock's movement is due to the performance of its entire sector. So if we see AMD is performing well, it might be that technology is performing well, and AMD is just along for the ride. The reason that this matters is because a lot of the reasons that these stocks' prices change is due to very tangible and very obvious things. Something like an economic change. Maybe there's been tariffs suggested on imported products from certain countries. For example, semiconductors are one of Taiwan's largest production materials and are required in many of the different microprocessors and technology products that we use. Of course, if there is now potential that the price of those semiconductors is going to skyrocket, technology companies won't be too happy. Let's say a big boat gets stuck in the middle of the Suez Canal, and now their supply chains are disrupted. That's going to impact stocks prices. There are so many different economic changes, supply shortages, interest rate changes, labor shortages, labor surpluses, anything and everything that can affect how well a company can perform as a company is going to impact the stock price. And typically, if an issue is impacting one company in a certain sector, it's also impacting all of the other companies within the same sector. So that is where the idea of sectors really comes from. It's convenient to be able to group all these companies into 11 different groups, but really the true value for as investors for sector rotation comes from the fact that at any given point, the majority of companies in a sector will be moving in the same direction because of the same reasons. I want to show you some examples. Here, we're comparing ExxonMobil to its sector, energy. So what we're going to do is look at a relative strength chart. Do you need to know what relative strength charting is? No. Do I expect you to understand what this demonic game of tic-tac-toe is? Also no. I'm going to walk you through it. What we're doing here is comparing ExxonMobil to its sector, energy. If ExxonMobil was performing much better or much worse than energy, we would see this chart go up or down. Going sideways means that it's not really changing that much. Or rather, when ExxonMobil moves, energy moves as well. Or when energy moves, ExxonMobil also moves. For some point of contrast, I think this would actually be fun. Let me pull up a chart for Tesla versus its sector. So you can see an example of what happens when sector rotation isn't, or the stock doesn't follow its sector. Okay. 2025 starts right down here where you see the 25. Everything before this is 2024. I have to scroll up and down to see the full extent of the chart. Light, you good there, bud? You're good. I have to scroll up and down to be able to see the extent of this chart because the price of Tesla changes so much more than the price of its sector. So this is a clear example of Tesla does not follow the performance of its sector. Contrast that with ExxonMobil. The fact that ExxonMobil's chart, we can see all of 2025, 2024, 2023, and half of 2022 really shows us that not much is happening in the way of one doing better or worse than the other. So this is a clear example that sector rotation or the performance of a company can be dictated by its sector. Here's another example. MasterCard and its sector financials. Is it as perfect of a line as ExxonMobil? No. But is it as crazy as Tesla? No. I've fit all of the data from 2025, 2024, and half of 2023 in a single page. And there's no scrolling up or scrolling down to see it. Everything is right here. This is showing us that these companies are falling in line with their sector. And that means that if we want to enjoy what Intel, what AMD, what NVIDIA are doing, yes, we can invest in all those individual companies, or we can invest in the sector or the sector itself. which does have its own benefits and drawbacks. But if our goal isn't to turn investing into a day job, or if we just want to take some control over our investments, but don't want to deal with it every day or every week, understanding this basic idea can go a very long way. So let's take this a step further. Sector ETFs offer us a way of comparing and grouping these companies together based on what they do. So we've talked about the fact that similar companies will often move in the same direction. But can we actually invest in that sector? Like I said before, if you want to get access to all of these technology companies, is there a way to buy technology? The answer is yes, there is. There is something known as an exchange traded fund, or ETF. These ETFs are gift baskets that are made especially for you, where if you wanted to buy technology, you can invest into an ETF, and then they will buy and sell a bunch of stuff for you to be able to say you are investing in technology. In reality, from your side of things, it's so straightforward. You can buy an ETF right off of the stock exchange. You can hold it right next to all of your other shares of other stocks, and its price goes up and down throughout the day. But the big difference here is that an ETF's goal is not to make as much money as it possibly can. Its goal is to copy and follow the performance of whatever it's tracking. In our case, what it's tracking is a sector. So there is a group of funds called State Street Spider, SPDR. And this group offers 11 different ETFs, one for each of the different market sectors. These funds will invest in S&P 500 companies, so 500 of the largest companies in the stock market, but only if those companies belong to a certain sector. So technology will invest in technology companies within the S&P 500. Healthcare is going to invest in healthcare companies within the S&P 500. You probably will get where we're going with this. Financials is going to invest in financial sector companies within the S&P 500. Now, the very interesting thing here, these funds are market cap weighted, which means the bigger the company is, the more value it has in that fund. So you're not going to see that technology is equal parts NVIDIA, Apple, AMD, and Intel. Instead, you're going to see that larger companies like NVIDIA, Apple, and Microsoft have much more value than the smaller companies do. I want to show you a good example of this. Give me one moment. So if we go here and we look up the energy sector, just because we were looking at it before, we get a web server is down notification. Let's try that one more time. Okay. So State Street Spider has a fund for energy, which is XLE. So if you went to your broker and said, buy me XLE, they got you. They'll buy this. If we go to holdings, we can see what they're actually buying in this fund. So ExxonMobil, 22%. So when you are buying XLE, 22% of what you're buying is ExxonMobil. 15.7% is Chevron, 8.1% ConocoPhillips, so on and so forth. Great. We already talked about the fact that ExxonMobil follows the performance pretty similarly to the entire sector ETF. Now, you might be thinking, is that fair that I put the biggest company up against the performance of the sector? Well, let me show you this. If we look at consumer discretionary are all the luxury goods in life. It's your I want to haves, your vacations, your cars, your leisure products, and also Amazon and Tesla. Those are the ones you probably care about. Speaking of, Amazon, 20.1%, Tesla, 17.9%. This goes to show that just because a company is a large part of a sector, it doesn't mean that that is the reason the sector is going up or down. We saw before, the performance of Tesla's sector was not the same as the performance of Tesla itself. So there's no magic going on here that I'm trying to show you. The real magic is the fact that sectors allow us to buy dozens of companies by just buying one single thing. And because the majority of the movement of a sector or the movement of a stock's price is due to its sector, here we're just cutting out the middleman. Now, 100% of the performance of our sector is due to our sector. And that's the goal. So sector ETFs offer us a lot when it comes to investing, especially if we're new to investing, risk averse, or we just don't want to spend a lot of time doing it. Let me show you. Sector ETFs, in my opinion, are very beginner friendly because you can study the whole stock market through just 11 different things, one for each of the sectors. Plus, sector ETFs are a group of companies. If one company has some bad news come out, or if someone did something stupid and that stock's price fell, you are not along for the ride. You aren't stuck if one company starts to do poorly, because you instead are looking at the performance of the sector, which tend to be more stable. Is technology going to be the next Nvidia? No. Can you expect the same level of returns that you could expect in Nvidia? No. But let me show you the other side, because it's always nice to look at when things go right and say, oh, we could have made so much more money, right? Well, things don't always go right. So let me pull up for you all the graph of... I upgraded my computer to Windows 11 and I can't get used to it. Cool. If we look at the year-to-date return of Tesla, looks pretty decent, right? Well, what you don't see is over the past month, it's down 14.4%. That's a pretty big loss. If you heard from some friends, hey, look, Tesla's going up, it's going to the moon, we're about to buy all of our Lamborghinis. Yeah, that's great, but you lost 20% of your money over the, or rather 15% of your money over the past month. What is discretionary? XLY done over the same period. 17.4% loss. Or sorry, 17 point... numbers are hard today, apparently. 7.14% loss. There we go. Half as much as Tesla. But if we look at the 1-year returns, we're up 27.6% versus 80% from Tesla. Is it as beautiful and attractive as Tesla? No, but it's not meant to be. The goal of a sector is not to make you a millionaire overnight. The goal is to allow you to get the benefits of certain sectors or certain areas of the market or certain companies while avoiding some of the risk. You are not stuck with whatever the heck is going on with Tesla that day or that week. Instead, you are relying on the performance of the entire automotive industry, Amazon, and all of the other discretionary companies as well. For some of you, that might be a benefit. For others, it might be a drawback. The goal here is not to tell you why it is the only thing you need. It is just to show you that this is something that you could use. So, again, sector ETFs are often seen as less risk, but also less reward than individual stocks. Also, some people will think funds are expensive. And the reality is they are not. Yes, funds do have what is known as an expense ratio or a fee that you have to pay, but they take that right out of the price of the stock or the fund itself. And that percent, especially for the sector ETFs, is far less than 1%, somewhere in the range of 0.1 to 0.15%. Really, really small. So that's what sectors are. Market sectors are a way of grouping companies based on what they do, can be invested in because we've learned that the majority of a stock's price is due to its sector and not the company itself. And through sector ETFs, we have the ability to invest directly into that sector to be able to diversify what we're investing in with much less effort. But there's one big question left. What sector do we invest in? Because really, what we've done now is we've boiled down 5,000 companies into 11 different sectors. But now we still need to pick which one of those sectors do we want to buy. And thankfully, you don't need to take my opinion for which one you should buy, because there is an entire school of thought, an entire way of investing that I didn't invent that covers exactly this. And it starts with the market cycle. The market cycle is a very basic idea that we have bull markets and we have bear markets. And that makes up the market cycle. Bull markets are periods where stocks are generally going up. You'll see that the stock market will gain a bunch of value. Investors are really happy. Everything's going great. All good things must come to an end, and eventually the market peaks, stops going up, and begins to decline. Before we know it, we've had the stock's price or the market has fallen 20%, and all of a sudden investors are panicking. The economy's not doing well, the stock market's not doing well, no one's having a good time. This is a bear market, where stocks are generally going down. And then finally, when recovery begins and stock prices begin to move in a positive direction again, the whole cycle repeats again. This is not something I invented. This is something well studied and well accepted in the stock market. Thankfully, bull markets last longer than bear markets, and over the past 100 years, there has never been a bear market that the stock market has not recovered from. We always see higher highs and higher lows as well. But what about our sectors? Where do our sectors work into all of this? Well, during different parts of that market cycle, certain sectors will perform better than others. For example, in a bull market, communications, industrials, and materials are typically sectors that will perform very well. The reason is that when a bull market is going on, people are making a lot of money. Money tends to be pretty cheap to borrow, and a lot of investors and businesses will use this time to grow their money. They're going to start to buy product to build a new store. They're going to start expanding. They're going to start hiring more people. They're trying to grow their businesses as fast as possible, and as a result, grow their share prices as fast as possible. So sectors that benefit a lot from these good times in the market will be the ones to perform the best. But again, all good things come to an end, and bear markets must happen. As the cycle slides into a bear market, we start to see that these good times sectors begin to underperform, and instead, we see that the sectors that perform the best are the ones that you still need even when things aren't going that great. Everyone still needs their staples. Staples being basic household goods, paper products, um, certain restaurants and basic department stores are going to fall within staples. These are the I needs in life. Healthcare, reality is we always need healthcare, we always need hospitals. And utilities, we still need our gas, we still need our electricity. So even when the stock market is going down, certain sectors might be going down less or might even be turning a profit, while others are not. This idea of market cycle and sectors is well studied and well understood. And this is what we know as sector rotation. It is a very simple idea, but at the end of the day, the biggest challenge is in how we can use it. So sector rotation is simply the process of taking the market cycle and some other things such as seasonality, aka what month out of the year is it, sticking them all together and using that as a way of saying, these are the sectors that should be doing the best right now. But also, if we can predict or understand market sectors and sector rotation, we can then figure out which sectors might be the next to succeed. This cycle is so well understood that we can understand that industrials and materials will perform well, then energy, then healthcare, utilities and staples, then technology and discretionary, and then communications, and then industrials and materials again. It makes it easy. If we know what sector is expected to do well in the future, suddenly the market doesn't seem so random and doesn't feel like we're just rolling the die expecting us to make some profit. So sector rotation is a very simple idea, and how you trade it is very simple. Sector ETFs. The big challenge is, where are we? Where are we? Who is the leader today? Who might be the leader tomorrow? Because the reality of it is, a bull market can go on for a very long time. For example, right now, we've seen the stock market has been in a gradual increase for the past 2 years. We've been in a bull market for over 2 years. The average duration of a bull market is just around 3 years. When's the bear market going to begin? Could it begin today? Could it begin tomorrow? Is it already happening? We don't know. Welcome to the stock market. There are simple answers. We'd all be millionaires. We'd all be Warren Buffett. So the biggest challenge of sector rotation isn't what do we invest in? It's where are we in the cycle and what sector should be doing the best at that time. Before we go on, I want to answer a couple of questions that we have here in our chat. Jonathan, is it more convenient to buy the ETF of a sector or the individual stock of that sector? Great question. Are you buying it because you believe in the company or you believe in what the company is doing? If you believe in the company, say you really like electric cars and you think Rivian has a lot of potential. Again, not a recommendation example. You think Rivian has a great opportunity. Amazon has partnered with Rivian to convert all of their delivery vehicles over time into electric cars. That is a huge guaranteed sale. Or maybe you think NVIDIA's new line of graphics cards are going to be super powerful and you bought a graphics card and you want to own the company too. Sure. There are a lot of instances where you will buy an individual company, but it's because you believe in the company itself. If you believe that right now we are entering a bear market and you want to invest in something defensive, you might not care about all of the different utilities companies. Do you care about regulated water companies? I don't. I'd rather watch paint dry. But does that mean that the utilities sector is a bad sector? No. It just means that if I'm investing in utilities, I want to invest in the sector, not the company. So there is opportunity and reason to invest in both individual companies and sectors. The reality of it is, though, most people that invest will invest in companies. So my goal here isn't to highlight the benefits of investing in individual companies. Instead, it's to show an underrepresented and underappreciated opportunity to invest in entire sectors themselves. So realistically, both can work extremely well in any portfolio, regardless of how much risk you want to take on. Sector ETFs just provide a more trackable way of understanding market behavior over time. Is it safer to invest in sector ETFs than individual stocks? On average, yes. On average, sector ETFs will be less volatile than the most volatile company. So, for example, Tesla is extremely volatile. It is probably one of the more volatile stocks within the S&P 500. Something like GameStop is extremely volatile. And that volatility offers high risk, but also high reward. So is it safer to invest in sector ETFs than stocks? On average, yes, it is. But remember, a sector ETF is just an average. It is a weighted average, meaning the bigger companies matter more, of a sector, which means its risk is going to also be an average. So you're going to have higher risk and lower risk all put together. It doesn't suddenly avoid volatility entirely. So take that with a grain of salt, that on average, they typically are less volatile than individual stocks, but your mileage may vary depending on what sector and the reasons why that sector's ETF is going up or down in the first place. So now, what I want to look at with you all is why figuring out who the leader is today is such a big challenge, and is really the only reason why I don't get up here and say, you should be using sector rotation. It is the only thing you should focus on. It does not come without its challenges. And to do this, I want to use an analogy. Let's paint a picture. What is this a painting of? I think the slide got a little bit messed up because I promise you I'm trying to show you something that's not just a blank screen. So let's try this. What is that a painting of? Any guesses? How about now? A little bit wider of a picture. Still no idea? How about now? This style of portrait or this style of painting is known as pointillism. You take a bunch of little dots and you put a bunch of little dots in one place. And as the picture grows, these little dots become different colors. Is there a single color that makes up his face? No. Every color is just a bunch of different colors put together so your eyes start to see it as one color. When all of this comes together, it makes a big picture. And that big picture we can understand. You look at this and you say, this is a person. It is a man, he has a mustache, and some pretty fancy hair. But if we go back to just this, now that you understand what it is, you can start to see the hairline here. You can start to see the skin. By understanding what the big picture looks like, when we zoom in and we start to look closer, now the details pop out. I promise you, if you look at this more, you're not going to unsee his bright, shiny forehead. They literally put a little bit of white in there so it glistens. It is shiny. That is the idea of investing in sector. You start off by looking at this very obscure, way too close in idea. And this is where many people are with investing. They see a bunch of little dots and they can't see the big picture because the big picture is confusing. And over time, as we zoom out, we do get to see the whole picture. So when we go back in and we zoom back in again, now we know what we're looking at. We can say that is hair and that is a shiny forehead. So sector rotation is a long-term cycle. These bull markets and bear markets take place over a series of 4 to 5 years on average. That is hilariously long. Does that mean that through a bull market, communications, industrials, and materials will always be doing the best? No. While our whole picture is still a person, it changes daily. Each individual dot on that picture is a completely different color. Look in again. If I had a picture taken of me and my face was blue, I would be a little worried. But this guy's neck is all blue, orange, red, yellow. Those are not natural or healthy colors for a human's face to be, but that is how it looks. And when you look at the big picture, it makes sense. So within sector rotation, sectors will gain strength or lose strength every single day, every single week, every single month. So just because we understand this big picture idea of sectors doesn't mean we know the whole story. Because it's great for us to understand that. But when it comes down to us investing today, and we have to figure out what do we invest in, you're not painting the whole picture. You're not making the whole owl. You're just making that first dot, that first little brush stroke. So that's where I want us to focus. So figuring out what's happening today is extremely important. And it can be difficult to know where in the market cycle we are. The stock market is not a straight line to the riches. It will have its ups, its downs, its bumps, and its valleys. So the best thing we can do is look at the dots. Look at what dots are around us. And just like that picture, just like this picture, while the first time I showed this to you, it made no sense at all. Now that you understand what the big picture is, this makes sense. You can tell me that's the background, that's some hair, and that's a shiny forehead. The same thing can and will happen with sector rotation. You will look at the individual dots and a decent picture of a section of dots, and because you understand what the big picture looks like, you will be able to figure out what we are looking at within those dots. Do you need to do this alone, though? No. The reason that Sectors Made Simple is here is because sector rotation is at the core of what we do. And that's why I wanted to cover this topic, and that is where I want to dive into now. I want to show you that sector rotation trading can be made very simple regardless of if you pay for a Sectors Made Simple subscription or not. The first tool that we released almost 5 years ago is a page that compares the 11 different market sectors. We find which ones are winning or are performing the best, both short-term and long-term, and we give them a score based on their performance. The higher the score, the more strength that they have. So, from this table over here, we can see all of the different sector ETFs. I apologize if it's a little bit small. But at the top, we see that XLE, which is the energy sector, has the highest total strength, overall strength. Second is financials with 15, and discretionary, or XLY, is in third with 14. So if you had to ask me right now what sector is performing the best today, I'd probably point to you and say energy. But this is only half the story. It's really good to know who the winners are today, but if you're investing a little bit more actively, if you want to be buying something and then once it starts to underperform, selling it and moving into the new thing, you want to basically turn it into our iPhones. We can track the changes in relative strength over time. Or what we can do is see how today's strength, today's scores, compare to one from the past. We call this momentum. So momentum shows us how much strength each sector has gained or lost over a period of time. So what you see above me is the momentum for 1 week. So from today compared to 1 week ago, we find that materials, XLB, has gained the most strength, while technology, XLK, has lost the most strength. With that said, I want to show you 3 examples of sector rotation trading. Method 1, without a subscription. Promise you. Even if you don't have a subscription to Sectors Made Simple and you have access to these tools yourself, we still do publish a newsletter once a week that you can get access to. These newsletters include the current the current matrix as of Friday, along with the 1 week momentum chart. So there you get the current leaders and who's gaining or losing strength, along with all of my insights as to what is moving the market and why it's moving. With this information, we can pick out a sector that is gaining strength or is already a clear leader. Simple. It's a great way to start exploring our information with no commitment necessary. And again, to get access to this newsletter, all you have to do is sign up for a free account with Sectors Made Simple. Your free account does not have a limit of how many newsletters you can get. It gives you access to tons of educational material on our website, guided, completely free introductions to investing, to our tools, and more. So really, this is your one-stop shop for anything and everything you could learn about sector rotation and the basics of an investment strategy. No subscription necessary and no time limit on your access to that material. The second one has become the staple of Sectors Made Simple, and it's our weekly trading strategies. To try and make sector rotation even simpler, we've developed a number of different trading strategies that use our matrix and momentum, so use sector rotation to pick different sectors to invest in. They invest once per week, and Sectors Made Simple paid subscribers get access to see all of the strategies that we offer. Here, you'll find a list of trading strategies, the steps they use to choose sector ETFs, and their historical returns. There's no pretending that our strategies do something they can't. There's no showing you the one very nice result and ignoring all the others. At any time, you can go in and check the performance of all of our strategies. And if you find one you like, you can follow the steps to trade it, or just see what it's holding. Our strategies will say, currently holding energy, in big bold letters at the top. But if you want a little bit more guidance, or you want to continue learning about these strategies, I do updates once per week where I go in and look at the strategies, figure out what the strategies are picking for that week, and give my personal analysis and personal opinion on what I will choose for the upcoming week. I do put my money where my mouth is. I do use these strategies myself every single week, and I share that process and that journey with you. Now, a quick aside here. In preparation for today's webinar, I wanted to go in and there is another, I'm not going to start naming names here. I want to be fair. There is an analyst that works with one of the largest charting websites out there and one of the only services out there that offers relative strength information for sectors. I looked at what sector ETFs they picked last Friday. They picked 5 sectors. Of those 5 sectors, 5 of those sectors have gone down over the past week. In fact, 3 of those sectors have had the worst returns of any sector over the past week. So there you're picking 5 sectors and trying to figure out which one of those will perform the best. Meanwhile, in my webinar last Wednesday, I looked at all of our strategies. I believe 5 strategies were all picking the exact same sector, energy. And while the stock market has been down just about 1% over the past week, energy has been up over 3.3%. So not only did we beat the market, not only did we beat 5 sector picks from a top analyst from a top charting website, we did it by just saying, here's one sector, what do we think about it? And my personal opinion was, I liked it. Simpler, easier, and at least in certain instances, more effective. Win, win, win. Investing doesn't have to be hard. Sector rotation is so well understood because it works. The biggest challenge of sector rotation is just figuring out what the right information and the right tools are. And we have worked tirelessly for years to develop the set of tools and develop the strategies that we have. This is our bread and butter. This is what we want to share with you. We want to share with you an easier way to invest, one that takes this strategy, by the way. My actual webinars for these last less than 30 minutes, and mostly it's me just kind of chatting and talking about various things. But if all you wanted to do was follow a simple strategy once per week, it could be done in less than 5 minutes per week. We're not looking for hours of your time here. So, sector rotation has been made simpler with clear information that you can either explore on your own, explore with me, or follow these educational strategies that we've created. Let's say that's still too much for you, and your goal in sector rotation is just to invest long term. You want that slow tortoise, the low risk, consistent return option. Well, we've still got something for you. One way that you can use our tool is just go and look to see what sector has gained the most strength over the past 3 months. Whatever sector has gained the most strength, buy it and hold it. When do you sell it? Whenever you want. Or you can use something known as a trailing stop that sells if the price falls a certain amount to automatically sell for you. With that, you get told, or you get an alert saying, hey, we just sold your stock. And then you can go in, check again, and repeat the process. From the back testing that I did for this strategy, because I did want to make sure that this does work, in all of the testing that I did, the average held duration, so how long you held that sector, was around 5 months. So that means that all this strategy would take is less than 5 minutes once every 5 months on average. Doesn't really get easier than that. And still, you're taking advantage of sector rotation because we do all of the work for you. The hardest part is figuring out what information and how we use that information, and that's what we've done for you. We've taken the best of the best out there. We've turned it into something that is simple to understand and even simpler to use, and provided it to you. So, I hope that this has made you interested in the world of sector rotation. There are so many opportunities that we can discover beyond just buying the one sector, because with understanding who the leading sector is, we can then find leading companies within the leading sector. We can find opportunities to buy into options for leading companies and plenty, plenty more. But all of those are a story for another day. For today, I thank you for joining us for this amazing opportunity to explore sector rotation in more detail, give you clear examples of what it is, and more importantly, why it works, and how Sectors Made Simple is here to make the world of sector rotation simpler. If you have any questions, want to chat more with us, or want to see if Sectors Made Simple is the right fit for you, please send us an email at support@sectorsmadesimple.com. Thank you all so much. Hope to see you all back very, very soon.